We're looking at a rising net interest income throughout our country, the countries where we operate, including in Europe, on the back of the rate rises that have happened and the ones that are yet to come, and that should represent a good support for our net interest income, which should be growing in the year to come. Yes.
Carlos, the other point that I want to raise is what happens with provisions. And just diving into the part in Spain, the component there, I can see operating expenses and provisions specifically went down. At this point in the cycle where we've got rates going high, we've still got a cost of living crisis unfolding across Europe, inflation still at higher levels. At what point will you step up provisioning in the Spanish market?
Well, right now the cost of risk has been really subdued, and we have closed the year with 91 basis points. What we're looking at for 2023 is not much higher than that. Should be around 100 basis points across the different markets. We are very well provisioned in a prudent way. We have really not dedicated all the provisions that were set up after COVID. A lot of them are still there. Some of them are assigned to portfolios. Others are still to be assigned, the post-model adjustments. So the level of provisioning is quite high. The level of delinquencies we're seeing is quite low. It's an uncertain macro environment for sure. We're going to see lower growth, but still growth in the markets where we operate. Lower than 22, but still growth there with the uncertainty. So we'll have to see. But right now, we're quite optimistic.
Carlos, congratulations. They look a very solid set of numbers. But you know what shareholders are like. They're a greedy bunch. You've got a 5.5% dividend yield. That's very solid, of course, and good compared to the sector. And yet, the buybacks announced may underwhelm some. Do you think you could actually have a larger payout for shareholders, given your previous comments?
Well, we have, if you look back a couple of years, we have distributed, including the announcement we make today of 3 billion out of our net profits of 2022. In total, in the last 2 years, we've distributed 8.2 billion euros, which is a very significant amount if you take into account our market cap today, and more so if you take into account the market cap we had just a couple of years ago. So the commitment that we have to give the money back to shareholders is very clear. We have a target capital ratio of 11.5% to 12%. And right now, we're sitting at a 12.8% pro forma CET1. So we do have that excess capital. We want to use it to grow profitably, and this is what we have been doing. We have added 11 million new clients this past year. 55% of those came through digital, and this is an accelerating pace because the year before we added 8.7, the year before we added 7. So the pace at which we add new customers to the bank keeps growing, and this is the basis for future growth. That's why our loan book is also growing in the mid-teens and will continue to grow in 2023. And we're doing that with good profits, with a return on tangible, which is 15.3% this past year. So as much as we can devote it to our business, reinvest it in a profitable way, we're going to do that. And then the excess we're going to give back. We're very committed to that. So the decision today is really the payout for the 2022 profit. It's a very high payout, 47%, a big lift from the year before. But if we have excess capital, we will give it back as well.
It's a very strong road that you pointed there, above 15% as well. Carlos, what's the biggest risk? At the moment, we've got a very strange situation, and you know this as well as anyone, if not better than most. And that is the fact that the banks are finally getting a solid return on their deposits compared with the amount of money they're lending out as well. The net interest margins are looking very solid as well. But what is the big risk at the moment, given the fact that there is still a grave concern about Europe either going into recession or at least getting very close to it?
Yeah, I think the biggest risk have to do with the macro and geopolitics. We still have a lot of uncertainty around the situation in Ukraine, the implications that has on energy and commodities and on inflation, and then the second round effects of the inflation. We have seen today just the announcement, for example, of the minimum wage in Spain going up 8%. If we start having a lot of wage increases, which then translate also into other goods prices going up, that could be a circle of increasing or sticky inflation, let me put it that way, even if people are more optimistic now than a couple of months ago because the data are coming in a better way. But inflation tends to be sticky. So I think inflation would be, in my mind, the highest risk, and also the events associated with the geopolitics as I described.